How do you make lemons out of lemonade when the market's going down? What are some of the tax strategies you can consider, you should consider? One of them is tax loss harvesting, but there's 3 specific rules that you need to be aware of to do that effectively. I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Oh, it's disappointing to say, but tax loss harvesting is a strategy you got to think about and consider right now. The market has been up so much in 2019, 2020, 2021. You might not have a lot of securities that you can take that you have losses on in 2022. That would be fantastic. Obviously, values have gone down over the past 6 months or so, but you might still not have ones that have losses where you've lost money compared to your cost basis. However, those of you that are contributing more frequently or make changes a lot in your non-tax sheltered accounts, your joint account, individual account, your brokerage account, whatever, not your IRA, your 401k, your Roth IRA, you can't do tax loss harvesting in those. Those are tax sheltered. But the accounts that you might hold outside of that, maybe if you've got losses, you might want to consider capturing those losses so that they're a deduction on your tax return, or that they at least are deductions to offset future or other gains that you might have. It's called tax loss harvesting, okay? The reason why you would consider doing it is you can use those losses to offset other capital gains. And if your losses in any calendar year, tax year, exceed your gains, you can claim up to $3,000 of those losses on your tax return and then carry forward the rest of them to offset future gains next year. Or if you still don't have enough gains, you can claim another $3,000 of capital loss on your tax return next year. Why is that so important? Well, it does help offset capital gains, but the other reason it's so important is if you end up with that $3,000 loss that you can claim on your actual tax return, it moves that loss from negating capital gains, which is at a tax favored rate. It moves that loss to actually being a loss against ordinary income, which means it would be a bigger or more important tax deduction than you would otherwise receive. So tax loss harvesting, something you've got to be doing. If you're not working with a certified financial planner who's doing comprehensive financial planning, they're probably not helping you with tax loss harvesting, okay? Hopefully you don't go through it a lot, because that means it's a strategy to employ during down markets. But and when we do face down markets, if it's something you're employing, you've got to make sure you're aware of these 3 rules. The first is the wash sale rule, and really there's 2 parts to it, but the first part of the wash sale rule is you can't reinvest. Once you sell that investment, you can't reinvest into it within 30 days. That's the common definition, the common understanding, but it's actually 61 days total. It's 30 days prior to the day right now and 30 days after. So in total, it's really a 61-day window. Well, why is that? Well, let's say you got really creative and you said, yeah, I'm gonna capture some losses on this specific investment, but I want to keep holding that investment. Say, Chevron stock has done fantastic recently, but you've got some losses there because of what's happened in the past week or so. So I still want to hold my Chevron stock, but it's gone down recently, and therefore I'm going to buy 500 shares of Chevron today, and a week later I will sell 500 shares of Chevron that I held previously. I'll capture the loss from the sell, but I'll still own those 500 shares because I bought it in advance. That's a no-no. That's wash sale. Most often, you might not have that amount of cash to buy in advance of selling. And so most people look at this in the traditional way, and that is if you sell your Chevron stock one day, you can't buy that Chevron stock back within 30 days. You've got to wait. That's the first rule, to make sure that you can actually use the loss that from your sale. Otherwise, it would be negated via a wash sale rule. You wouldn't be eligible to take that loss on your tax return. The second rule is sort of the second component of the wash sale rule is you can't reinvest, or you can't buy the substantially identical security during that 61-day window, okay, the 30 days prior or the 30 days after. You can't buy a substantially identical security. Now, wow, well, what does that mean? The IRS has had this rule for a long time, and they've continued to be vague on this, okay? Where they have applied, and I'm not going to hold myself out there as being an expert on the IRS's interpretation of substantially identical asset or security. Not going to do it. There's a lot of ambiguity there. But there's some resources here I've linked in the description, sharing some as well right now in the video. Basically, it's suggesting if you own an individual security, an individual stock, you can't buy that exact same stock within that window. Can't do it, okay? When you hold an exchange-traded fund or a mutual fund, it gets more gray. I would look at if you sell the Fidelity S&P 500 index fund, to me, it's substantially identical to buy then the Vanguard S&P 500 index fund. That, to me, is substantially identical. However, the IRS, I don't believe, has enforced that yet. They look and say, well, Fidelity and Vanguard, those are two separate companies. They have separate cost management structures, expense ratios, those sort of thing. And so I believe the IRS has still said, hey, those are different. I'm looking at it, and there's some Morningstar data in here as well that suggests, no, if the actual investment overlaps by at least 70%, the IRS really could consider that as substantially identical. That passes my logic, okay? But you've got to decide that on your own. Work with your certified financial planner, but just know that you're not able to reinvest those dollars or buy a substantially identical security within that 61-day time period as the one that you just sold. So those are the first two rules. They're embedded within the wash sale rules for tax loss harvesting. This final rule is about practicality. Whatever you do, reinvest the proceeds in. You sell an investment to capture the loss. Whatever you reinvest those proceeds in, make sure it's an investment that you are comfortable holding. Make sure it's something that you want to hold. More often than not, as we talk about this with clients where we're maybe not doing it as part of our overall portfolio, if it's just a one-off situation, typically clients will say, well, I guess let's just buy this because we're going to sell it in 30 days anyway. Well, maybe not. Maybe not. What if in those 30 days, the investment that you purchased while you're waiting to get back in the one that you just sold, the investment you purchased skyrockets in value? Well, then if you sell that to get back in what you just did, you totally negated all of this to begin with because you captured a loss and then you had to capture a gain. And worse yet, that gain is a short-term gain. So way too often, people that are trying to get too fancy or creative with these tax loss harvesting, they'll just buy something they think, oh, that would be neat to invest in. We'll see if that goes up in the short term. But then it does go up in the short term, or they happen to time this uniquely, coincidentally at a good time in the market. The rising tide has lifted all boats. And all of a sudden, if you sell this investment, you've got to realize some short-term gains. That's a no-no. So to me, if you're selling an investment to capture a loss and you're wanting to reinvest those dollars so they're not just sitting on the sidelines, I agree with you. Make sure you're reinvesting those dollars into an investment you would want to hold, an asset you'd want to hold for a long period of time. Now, if the market doesn't move much over those 30 days and you really prefer the investment you just sold, great. Sell that one you just purchased and get into the other one. But if you just know there might be reasons why you're going to be holding that investment for well beyond 30 days. You're going to want to make sure it's an investment you're comfortable holding for that long. The big idea with tax loss harvesting is working with your certified financial planner to ensure that this is a strategy that you should employ, that you've done the tax projecting and analysis to say, yep, this is a good fit, here's how much we should be doing, and that it fits within your overall investment strategy to say, here are the pieces that we're going to pluck out, and here's what we're going to do with those proceeds to make sure that we're following these three rules. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.